Thanks, everyone. A very interesting presentation. I can tell my mom, she's a Shanghainese. When Disney announced the plan to build the park in Shanghai, she did ask me maybe she should buy some Shanghai local stocks related to the Disney concept. Anyway, maybe it's a 20-some slides presentation, so maybe I can start the question with Professor Seasholes. Maybe you can briefly tell us what is the biggest difference in terms of investment behavior, between the retail group and the institutional group of investors you see, or perhaps they also have something, share in common. And we'll be also happy to hear, Alan, Richard, and Angelina's view. And Alan and Richard are very, professional, famous asset managers in town, and Angelina, you used to be a regulator.
Okay. Thanks. I'm going to answer shortly and then pass on to people because I think we want to hear their experiences. Certainly some behaviors like home bias seem to exist across the spectrum, from the least sophisticated retail all the way through the mutual fund manager. Probably the offshore hedge funds are the only group that are kind of free from this bias. On the a big difference would be in the buying behavior, where the limited attention seems to really limit and dictate which stocks an individual might buy on a certain day. The flip side on the similar behavior would be on the selling. We didn't talk about it, but what's called the disposition effect. No investor that we've ever seen likes to sell at a loss, and they tend to hold on to stocks that are underwater, that are lower than their purchase price, like there's no tomorrow. So we see this in real estate markets around the world. We see it in stocks, and it's a strange behavior because there's nothing forward-looking about it. You have a stock that you bought at 91, like my example. Let's say it's down to 80. You should just be thinking about the future prospects of the stock. If it's going down another 10, get rid of it now. But if you just hold on to it, it's not doing you any good. And I think we see this behavior across all people. But now I'll let some of the panelists talk about their clients, because I think we'll learn something. Who wants to?
Maybe Richard?
Well, I think regarding the investor, whether we just hold on to the losing positions, I think this is common. I mean, I think that's why a lot of behavioral finance funds or claim that behavioral finance and studies that say, okay, the only way to try to avoid human bias or mistakes is not to let human make decisions. So indeed, actually, I think if you come across those funds who claim themselves as behavioral finance driven, it's like, okay, you just do it by rules. Okay, you set up the rules and then minimize the human interventions. Okay, and let rules do it, and then they would they probably would do better. And so, of course, the rules is like, okay, try to avoid sentimental factors, because I think typical I think regardless of retail investors or high net worth, I think probably Alan can also share my thoughts. It's like our observation is like when they make money, they're easy to jump out to, okay, profit is profit. So they do take profit too early. They don't let profit run. But when they and then they said I look for trading ideas. Clients will come in and say, look for trading ideas. So how long are you going to trade? Okay, one couple weeks, 2 months. Okay, want to trading ideas, looking for 10%, 15%. Great. Then they say, okay, but you got to stop loss, right? When you trade, you really have to discipline. But of course, when the stock started to go south against them, I said, oh, this is my long-term investment. So yeah, I think that is very common, and so people will see, okay, I'm looking for trade, and then when they get stuck, they will become a long-term investments. Then they hesitate, and indeed, a lot of times it's like it doesn't want to cut loss. So that is, I think, some observation we have. I think that's true, seems to be between retail and high net worth. Alan?
Good evening. Maybe I just start to talk about individual versus the institution. investor because I was a trader before. I started my career as a trader on the U.S. Treasury and commercial papers market. Okay, so I managed the money market desk for over 10 years. Okay, the only rule that can make you be a winner is discipline. Discipline means I haven't seen a bank or a institution use the computer decision to make trading. Never. If there's any one company using this methodology, you better bet against it, okay? Because you will be the winner, not the computer, okay? When we talking about individual versus institution also hire individual as a trader. So what make the trader make money? Is the discipline, because you set him or her a trading limit on a daily basis, on a monthly basis. You have the cut loss limit, okay? And then you regulate, I think, all this, activity under a risk management framework, okay? So, and the management can see overall the position of each of the trader, and then he manage, I think, how to mitigate the risk. If there's too large, too big, I think, position, or the market, I think, is behave or moving, I think, against, I think, the bank's, I think, position. However, when I look at my peers group, I think at those trader, if they invest on themselves, they just like a retail investor, because they set the rule and then they override it, okay? Because you provide, you bet on your own money, and then you are the master of this position. So you overrule every time, okay? So end up you become a retail investor, okay? And then you sit on the loss forever, and then you try to double up, and then eventually bankrupt, maybe, okay? My clients, I think, is private bank customer, so they are considered to be the most smart person, because each of them may be very successful, I think, in doing their own business, making a lot of money, okay? However, when you're talking about investment on their own, not much difference, I think, from a retail one. If you do the KYC, the questionnaire, everyone looks conservative. Okay, I can't take risks, I have to manage it. And when you look at the return, expected return, they all become aggressive. Okay, and that's misalignment. Okay, for those mainlander, I think, billionaires, okay, they are very confident on themselves. Okay, so they are concentrate on a few asset class, which they think they lose better than the rest of the market or the other people. So when you're talking about diversification, you must have a certain percentage in cash, certain percentage in bond, equity. The investment consultant and the relationship manager, most of the time, just talking to a wall, no response. They just keep on taking this position until, I think, one day it suffer a heavy loss, and then they may think about to cut it or to just, I think, keep it forever. They never want you to talk about that, so you better, I think, keep away to mention this during the dinner or the lunch, okay? So talk about something, another topic, okay? So not much difference, I think, from my experience, okay? So the only rules I would say that we have to remember is discipline in investment, yeah.
Maybe Angelina has some different views from your past regulatory experience.
I think that's the best approach that I'd like to take. I was with the SFC for many years in Hong Kong for 8 years, and one of the opportunities that I got was to spend about a month and a half living in Beijing working for the CSRC. And this is in 2006, and I think this was one of the most amazing periods of time in China, because it was just when the market actually crashed, and I don't think this was public knowledge, but the CSRC at the time was dealing with a huge portfolio of securities firms that had collapsed. And what they had done was they split out all the securities firms that collapsed and all the clients that lost money out of these securities firms, because the clients actually traded on margin. They were borrowing whatever way possible. And they were trading on rumor. And even when I was in Beijing at the time, in 2006, you'd have people congregating in front of the big securities houses. And at first, because I'm a Hong Kong person, and going up there, and you're seeing these individual investors standing outside, I thought it was a riot, or I thought it was a protest. But instead, it was actually people that were talking amongst themselves, trying to pick up what the latest rumor was. So if you're a regulator and you have to deal with these things, one of the things that the CSRC had to do was to clean up all these brokerages that had collapsed from bad risk management controls, from lack of controls, and from excess borrowing to clients, and clients just losing a lot of money. So the market was extremely volatile at the time. So what does this show you in terms of some of the individual investors' appetites? Well, basically, a lot of them were trading on rumor, and a majority of the investors in China, I think Dr. Seasholes has actually looked at a brokerage probably of very wealthy people, but the majority of people in China, and this has been told to me by our state-owned enterprise, our enterprise partner, basically I would say about 80 to 90% of the people are financially illiterate in China, which is pretty bold of a statement, but a lot of people don't understand corporate governance. A lot of people don't understand tracking stock and what is even discipline, or how to even study stock. And that was what the CSRC had to deal with in 2006 when they started cleaning up. And they cleaned up these brokerages, and some of them now, you know, Galaxy was sold, for example, to UBS, and UBS rehabilitated this brokerage. And other troubled brokerages have actually been sold to either US or European firms, and now are operating very, very well. So I think we have some statistics here that individual investors are major players in the Chinese stock market, and they actually contribute 80% of the total trading volume. And then this is the very sad one from the China Securities Journal, that 70% of the Chinese investors in the secondary market suffered average losses of 40,000 yuan per year in 2010. So if the average salary of an individual investor, average salary of a normal person in a non-public company is roughly about 40,000 RMB per year. If you're in a private company, it's about 25,000. That means you've lost a whole year of your salary. So to sum up on what I think in terms of from what the regulators are dealing with, they're dealing with a very uneducated group of investors. They put out rules. The brokerages really didn't listen to them at the time, and actually had very, very lax internal controls and lending policies. And on top of it, you've got investors that have a herd mentality. On the other side, on the institutional side, you have now a very big burgeoning asset management or institutional institutional firms. So some of the big ones like Bosera in China, they're really, really accumulating assets. These firms, talking about discipline, these firms are educated by a lot of sea turtles or people that have come back from abroad that may have worked from large firms and have learned discipline. But the big asset managers and institutional firms, what sets them apart is not only the discipline, but also knowledge. They come from very great schools like New York Stern, sorry, but they also have information flows. And for example, my brokerage is an institutional brokerage, and although confidentiality is important, we're telling our institutional clients that, look, we're seeing a lot of flow in these stocks, we're seeing a lot of interest in this or that. And if you're talking to 100 different brokers a day, that's a lot of information that institutional investors don't necessarily get. Retail investors don't get. And I think institutional investors, be it in China or in Asia or in the US or wherever globally, get this information. And I think that's what really sets apart the retail versus institutions. So discipline, knowledge, as well as information all play a part. So sorry, I've gone a little bit longer.
Follow up.